Hello everyone. In this lecture we are going to discuss about electronic payment system. So after this lecture you will be able to understand the different types and the mechanism that involve the payment system electronically. First of all, we need to understand the traditional payment scheme. What are those things? Issues of trust and acceptance play a more significant role in the e-commerce world than in traditional businesses. As far as payment systems are concerned, traditionally a customer sees a product, examines it, and then pays it by cash, check, or credit card. In the e-commerce world, in most cases, the customer does not actually see the concentrate product at the time of transaction, and the method of payment is performed electronically. So this diagram illustrates the traditional system in which a customer is buying anything, giving the payment to the businessman and gets the product. As compared to electronic one, the actual product is not be seen while doing the transaction. Electronic payment scheme enables the customer to pay for the goods and services online by using integrated hardware and software systems. The main objectives of electronic payment systems are to increase efficiency, improve security, and enhance customer convenience and ease of use. Although these systems are in their immaturity, some significant development has been made. There are several methods and tools that can be used to enable electronic payment system for its implementation. So this diagram illustrates how the electronic payment system works or scheme. While customers pay for goods or services by cash, check or credit card in a conventional businesses, online buyers may use one of the following electronic payment schemes to pay for their goods or the products or the services that are purchased online. For this, electronic fund transfer is mostly used, and it is used for transferring money from one bank account directly to another without any paper, money, or exchanging of hands. So electronic funds transfer involve transfer of money by financial institutions. We also have payment cards. They contain stored financial value that can be transferred from the customer's computer to the businessman's computer. Then we have credit cards. They are the most popular method used in electronic payment schemes and are used by charging against the customer's credit. We also have smart cards. They include stored financial value and other important personal and financial information used for online payments. We also have electronic money known as e-money or e-cash. This is a standard money converted into an electronic format to pay for online purchases. We also have online payment. This can be used for monthly payment for internet, phone, utility bills, etc. Electronic wallets. They are similar to smart card as they include stored financial value for online payments. We also have micropayment systems. They are similar to e-wallet in that they include stored financial value for online payments. On the other hand, they are used for small payments such as chorus in Turkey. Then we also have electronic gifts. They are one way of sending electronic currency or gift certificate from one individual to another. The receiver can spend these gifts in their favorite online store provided they accept this type of currency. Although these groups appear to be separate, there is some overlap among them. When the industry matures, this duplication in naming and function ought to be renamed. For example, e-wallets. E-wallets can be classified as payment card when they are used to store credit card information, or as e-money when they store electronic currency. The standardization of payment mechanism on the internet is essential to the success of e-commerce. Businesses offering domestic and international services must have assurance that payment will be received, that is, it is secure, and that is also valid. Addressing security issues is crucial to the acceptance of online payment standards. Consumers and merchants must be able to trust that their information is kept intact and remains secure during the transaction. For that, we have SET and SSL. These are the two standards that protects the integrity of online transaction, which we are going to cover in the later part of this lecture. So there are different types of electronic funds transfer. This is one of the oldest electronic payment system. Electronic fund transfer is the groundwork of the cashless and checkless culture, where and paper bills, checks, envelopes, stamps are eliminated. It is used for transferring money from one bank account directly to another without any paper money changing hands. The most popular application of electronic fund transfer is that instead of getting a paycheck and putting it into a bank account, the money is deposited to an account electronically. Electronic fund transfer is considered to be a safe, reliable, and convenient way to conduct business. So, we already discussed about what is electronic fund transfer. The advantages of electronic fund transfer is simplified accounting, improved efficiency, reduced administrative cost, improved security. Now we are going to look at the different payment cards that are involved when you are doing the electronic fund transfer. First, we discuss about the credit card. There are two types of credit cards on the market today. One is the credit card issued by the credit card companies, for example, Master or Visa, and they are given by major banks, for example, Bank Muscat, Bank Dofa, Nizwa, or HSBC. Credit cards are used based on the customer's income level, credit history, and total wealth. The customer use these cards to buy goods and services or get cash from the participating financial institution. The customer is supposed to pay his or her debits during the payment period, otherwise interest will accumulate. Two limitations of credit cards are their unsuitability for very small or large payments. It is not cost justified to use a credit card for small payments. Also, due to security issues, these cards have a limit and cannot be used for excessively large transactions. Credit card issued by the department stores, for example, we have Shukran card or any other card that is given by the departmental store, or oil cards from Shell or Maha. So in that, businesses extremely benefit from these company card as they are cheaper to operate, they are widely issued to and used by a broad range of customers. Business offers incentive to attract customer to open an account and get one of these cards. So the difference between credit card and debit cards is that in order to pay with a debit card, you need to know your personal identification number, that is known as PIN, and need a hardware device that is able to read the information that is stored in the magnetic strip on the back of the card. Debit card tasks similar to checks in that the charges will be taken from customers' checking account. The benefit for the customer is the easiness of use and convenience. These cards also keep the customer under his or her budget because they do not allow the customer to go beyond his or her resources. The advantage to the merchant is the speed at which the merchant collects these charges. Charge cards are similar to credit cards except they have no revolving credit line, so the balance must be paid off every month. Credit, debit, and the charge card methods of payment have been successfully utilized in the pre-internet period, and they are oftenly used in the e-commerce world as well. Some of the reasons for their popularity in e-commerce world are their availability. Most customers own one of these cards. Ease of use and acceptance. To use these cards as an online payment system, a well-defined process is followed. A brief description is to accept payment, a merchant must have a merchant account with a bank. The buyer will be required to submit their credit card number, that is CPC info, customer payment card information, expiration date, and shipping and billing information when making a purchase online using a payment card. A customer using his or her browser clicks on the product on the merchant's website and adds it to their electronic shopping cart. The customer provides the shipping instruction and payment card information. This information is sent securely over the internet to the merchant's commercial e-commerce site. The server software adds the merchant identification to the information transmitted. The merchant then submits this information to the acquiring bank, with which the merchant holds an account. The merchant bank transmits this information to the customer's bank for authorization. Then the buyer account obtained from then the buyer account information is verified. This involves the issuing bank from which the buyer obtained the credit card and the credit card association like Visa or MasterCard. Verification is received by an acquiring bank and is passed on to the merchant, who then ships the product. Payment cannot be issued to the merchant until the product has been shipped. So the process, when the product is shipped, then only the payment is given to the merchant. This entire process, not including the shipment, for example, takes approximately less than 30 seconds. So this is how the charge card verification works.